Welcome, crypto enthusiasts and crypto investors. Are you diving into the world of cryptocurrency and digital assets, and now you're concerned with your tax liabilities and your digital asset accounting system? Are you looking for an experienced CPA to guide you through the intricacies of cryptocurrency taxation? Look no further. In this video, we're going to go over what you need to know when it comes to cryptocurrency taxes and accounting for 2024. Why do you need to file cryptocurrency taxes? This is one of the first questions that I usually get from a new crypto investor or a new Web3 business, and the answer is simple. You're required by law to file taxes for cryptocurrency, and this is an area, despite popular opinion, that the IRS is very heavily focused on. The regulatory environment related to crypto started to heat up in 2023, and this is just continuing in 2024. The IRS works with many software and service providers on a contractor basis in order to help facilitate their technical needs when it comes to calculating and assessing your tax liabilities related to your on-chain transactions. This has been an area of focus for the IRS historically, and in the future, this is moving more into one of their main areas of focus when it comes to tax controversy and catching tax evaders. So this is something that if you're transacting with this, it's raising your audit risk and raising your overall tax risk, and you want to make sure that you report this accurately. Can the IRS track cryptocurrency? The short answer is yes. The blockchain, despite popular opinion, is not anonymous, it's pseudonymous. So even when it comes to non-custodial wallets, all the IRS needs to do is connect your identity to a wallet on the blockchain, and then those transactions will likely be associated with your taxes, and if you're not claiming them, you're going to have a tax problem on your hands. Additionally, there is 1099 reporting that is issued by many exchanges and third parties that are paying people in crypto, and that gets reported to the IRS. If there are discrepancies or underreporting related to any third parties that you've KYC'd with, this is another area where you're going to run into tax issues, and it's another tool that the IRS has at their disposal to know whether or not you have crypto. One of the biggest tools that the IRS uses is John Doe audits. We saw the most recent John Doe audit on Kraken. I expect to see this on more exchanges in the future, and we've seen this on many exchanges in the past as well. This is when the IRS goes to an exchange and legally takes the records of a large number of their customers, sometimes all their customers, sometimes customers that meet certain criteria. It usually ends up being thousands of customers. With this, they get all of their transaction information, KYC information. With the transaction information, it'll show wallets that they deposit and withdraw from. So the IRS is collecting this data, and then they're using software tools that they've partnered with third parties such as chain analysis and other tools to calculate what you owe based off of this data. And then that's how they know that you have crypto and will start sending out tax notices. So how is cryptocurrency taxed? Now I want to be clear here. The answer to this question largely is going to depend on the specific asset that we're talking about. Are we talking about a fungible cryptocurrency, a non-fungible token, a stable coin, CBDC, or another type of asset that you're transacting with on chain? Generally speaking, cryptocurrencies like Bitcoin are taxed as property. That means that anytime that you buy, sell, spend, or transact in this cryptocurrency, you're going to have a taxable event. That means if you purchase Bitcoin or you purchase Ethereum at $1,000, that would set your cost basis in that asset. If that same Bitcoin or Ethereum went up to $4,000 and you sold it, That would set your proceeds, and you would take your proceeds, 4,000 minus 1,000, and you would show a 3,000 capital gain in this instance. Because Bitcoin and other crypto assets are taxed as property and there's no de minimis exception, anytime that you spend crypto, even if it's in small increments, this will also trigger a capital gains event. You want to be aware of this, and you want to make sure that you're accounting for that appropriately and reporting it appropriately. Additionally, outside of reporting your capital gains, you also need to report income related to your crypto assets. So if you're earning in a crypto asset, this is going to be taxed as income based off of the fair market value of that asset when you're earning it. That will also set your cost basis in that asset for capital gains purposes, and then if you sell it at a subsequent date, the proceeds will get minus from that cost basis that was originally treated as income, to avoid double counting and make sure that you accurately report both your income and your capital gains. So the big thing to keep in mind here is that cryptocurrencies overall are usually going to be taxed as property, and understanding deeply the tax implications associated with every transaction that's taking place on chain, because the majority of these transactions, due to the nature of the taxation of cryptocurrencies, is going to be taxable. Now, when we get into these capital gains calculations, a big question that comes up, and that's something that's very important to pay attention to, is cost basis tracking. In the United States, cryptocurrency investors are required to use FIFO, first in, first out, for their cost basis tracking, unless they meet specific requirements, which will then allow them to use specific identification for tax reporting purposes. Now, I don't want to get too much into the weeds here outside of this high level summary on accounting method selection. This topic can get very detailed, and I've done a whole entire other videos to cover this. Just know that you're going to have to use FIFO unless you can meet the standards, in fact, at the time of transaction for specific identification. What does FIFO mean? FIFO means first in, first out. So if you've purchased Ethereum for the past 12 months and the price has been changing each time, and then on month 13 you go and you sell one of these Ethereum, you would take the first Ethereum that was purchased, say in January, and treat that one as that you're being sold first, and so on and so forth. Specific identification would allow you to choose which specific asset you're selling, but again, this needs to be properly managed on chain so you can match your accounting records up to the transactions that are taking place if you're going to try to assign a cost basis for a specific asset. So one thing I get asked a lot is, well, we have to report our cryptocurrency income. What exactly counts as income on chain when we're transacting in cryptocurrencies? And basically, anytime that you're going to be receiving value from a third party, whether for services that you're providing or from some action that you've taken that allows you to earn value on chain, chances are that these are going to be income to you and taxable to you. Some examples of this: getting paid in crypto, mining in crypto, receiving an airdrop, receiving new coins from a hard fork, staking rewards, referral bonuses, earning interest through lending protocols, learn to earn rewards, watch to earn rewards, browse to earn rewards, GameFi rewards, any form of rewards. These are all forms of income that you're going to need to treat as income based off of the fair market value at the time of the transaction. That'll also set your cost basis in that asset if you do decide to sell it after a period of time. So you won't be double counted on that income. An important thing to keep in mind is that when you're earning income on these assets, you are going to be taxed on the value of that asset at the point of sale. So subsequently, if these assets decrease in value, you're still going to owe the taxes on that asset based at the time that this transaction took place. So it's important to consider these income amounts at the time of the transaction and make sure that you're setting your tax liabilities aside, so you're not left in a position where you earn an asset that drops 50% before tax season and then you're stuck paying taxes out of this asset that is now half the value. Record keeping. So what do you as a cryptocurrency investor in 2024 need to do from a record keeping perspective? Now, this is an important topic that I've dedicated whole videos to, so I'm not going to go into deep details, but there's a few things that you need to know. You need to have a comprehensive record for every transaction that's taking place on the blockchain. And you need to have what's called an audit trail that can trace your transactions from your first transaction, from your inception to operating on chain, down to your last transaction, that shows the flow of all funds and how your calculation makes sense and how your cost basis transfers through to each asset. So we need to have a full consolidated history of all your transactions. We need to have a full gain or loss report, full income report, full detailed ending cost basis report, all with an audit trail that shows for any transaction, where was that transaction taking place, where was it originally purchased, what is the time and date, what wallet addresses are associated with both sides of the transactions. This is all information that we're going to want to use a cryptocurrency accounting system to consolidate and maintain. Now, it's important with this record keeping system and with your accounting that you do proper due diligence. In my experiences at Camuso CPA, most people that are self-managing their accounting and many people that are even using CPA firms are overlooking simple due diligence steps. These due diligence errors can impact your current year taxes, making them inaccurate, but because there is a cumulative nature to tracking your cost basis year over year, meaning that if you have Ethereum at the end of the tax year 2022, that's going to go into the next year 2023. So if there's any inaccuracies in your cumulative cost basis data, that can carry through into future tax years and cause cascading errors through multiple tax years of your accounting and tax returns. So record keeping and due diligence on your accounting and record keeping is extremely important. Additionally, for any unclear tax positions, we want to make sure that we're contemporaneously documenting these tax positions so we build a defensible position in the case of an audit. So is any crypto tax free? So there are certain transactions that can take place where you actually won't have a tax on crypto, and they're just non-taxable events. And this is something that I get asked a lot, so let me give some examples of that. Buying crypto with fiat cryptocurrency, so going from USD to a crypto, is a non-taxable event. Holding crypto, so if you buy crypto and you just hold it in your wallet, that's still not going to be a taxable event. So theoretically, you can buy a crypto with fiat, hold it in your wallet, none of that's taxable until you sell it. Transferring or moving crypto between wallets, as long as these are wallets you own, these are going to be non-taxable events. Gifting crypto, in most cases, these are going to be non-taxable events. There may be some tax reporting requirements depending on the amount, but usually giving gifts in crypto is not going to result in a tax. Donating crypto to charities is not only going to usually not result in a taxable event. There can actually be tax benefits and tax deductions that you get for this, but it's key that if you're donating cryptocurrency or digital assets that are valued over $5,000 to a charity, that we get a qualified appraisal for this. So these are some examples of cryptocurrencies that are cryptocurrency transactions that are not taxable. What are some other things to keep in mind? 2024 and moving forward into this year and into future years, tax enforcement is going to ramp up because cryptocurrency is one of the main focuses of the IRS. So I expect to see a lot of tax controversy, a lot of tax notices going out, and we'll be working with taxpayers to help them get through this process, from responding to IRS tax notices, assessing what these notices mean to taxpayers and what their options are for managing these notices, handling back taxes, handling back accounting, and then negotiating resolutions with the IRS. So I expect that there's going to be a lot of tax controversy in the future. We've most recently seen the IRS collect all of the tax data from Kraken, and we've seen that the IRS has recently posted on their website, based off of all the data that they've collected from Kraken and from other sources over the years, be it John Doe audits and other information collection methods, that they estimate only 25% of taxpayers are reporting their taxes accurately when it comes to cryptocurrency. So in other words, there's a 75% non-compliance rate that the IRS perceives. So I expect tax enforcement to ramp up to get a higher level of overall compliance for tax reporting related to cryptocurrency. Another overlooked area when it comes to cryptocurrency taxes in 2024 is related to NFTs, and the fact that there are sales taxes that can be imposed on purchases of NFTs in many states. Now, currently, this is going overlooked by most NFT sellers, and this is something that our team is working on trying to get a lot of sellers into compliance with. But this is something else that you should expect, that when you go to purchase an NFT, depending on your state and your location, you may have a sales tax that you have to pay above and beyond the purchase price for that NFT. And if you're selling an NFT, if you're an artist or you're a business selling an NFT, you may need to be collecting and remitting sales taxes for the sales to customers in specific states in order to be in compliance at the state taxation level. Are you looking for an experienced cryptocurrency CPA firm that can manage your on-chain accounting, that can help you with back taxes, that can help you understand and make sense of your tax liabilities and accounting on-chain? Look no further than Camuso CPA. We have been assisting clients with cryptocurrency accounting and tax preparation since 2016. Regardless of the level of complexity of your on-chain transactions or your tax needs, me and my team have you covered at Camuso CPA. Contact me and my team today to set a time to speak to me directly, and we can discuss your specific fact pattern and see how my team at Camuso CPA can help you.